A very good morning to you, traders. CPI day today, Wednesday, 13th of November. Hopefully something to keep us entertained later on. Before all that, we'll get through some of the headlines and data that's been out thus far. Starting in China, as we often do, there's been a couple of moves, a bit of a move in the yuan this morning. Dollar yuan a little bit weaker than we're seeing in other dollar pairs at the moment. That might have something to do with China has started offering its first dollar bonds since 2021. So a further move into raising money to throw at their economy. They've also apparently been talking to global bankers and asking their feedback on the recent stimulus measures and how they can go about lifting market confidence. I don't know why they're asking those global bankers, because those global bankers will just want more and more and more. But it's a sign of frustration from China, and also maybe that they might have to do a bit more to get that confidence growing about their fiscal measures and getting the economy moving. But we shall see. Over in Japan, we had some PPI data out last night, and coming in a nice healthy 3.4% year on year, beating expectations of 2.9%, higher than the 3.1%. Month on month coming in 0.2% as well, higher than flat expected. So decent inflationary numbers there from Japan. Over in Australia, we had some wage data that comes ahead of tomorrow's labour market data. Wage price index dropping quite significantly to 3.5% from 4.1%. This is quarterly data, hence why it can have a bigger mover because it's not monitored monthly. So the year-on-year number 3.5% lower than expected. Q3 number 0.8 lower than expected as well, though unchanged on the prior quarter. So some softening in wage data there for Australia. Coming over to European area, and Riksbank had their minutes and whatnot out, and they're waffling. Riksbank Governor Faden said there's no strong reasons for an additional rate path revisions. No more strong reasons for additional rate path revisions. It's important that domestic demand begins to rise. There's considerable uncertainty on the policy rate going forward. There's still few clear signs of a recovery in the Swedish economy, and November's rate cut was a well-balanced monetary policy move. So the weak krona is problematic and an upside risk for inflation. Still sees more rate cuts ahead in line with the main scenario. So long story short, they're going to continue on their rate cutting path. We're still messing around in Germany as to when they're going to hold this confidence vote. Yesterday it was touted as December the 18th. Now it's touted as December the 16th. So it's going to be December. Let's keep it at that for the moment. Over in France, and the central bank, some cheery thoughts going into year end, sees zero economic growth in Q4. It sees zero economic growth overall, but does see a slight rise in underlying activity in Q4. So no jelly and ice cream going on over there, and the economy into the latter part of the year. Big Hawk, Catherine Mann at the BOE says inflation has not been vanquished. Headline inflation masks underlying dynamics, and that service inflation in the UK is still pretty sticky. Says the threat from upside risks is from energy prices. She says she sees more volatility and upward bias to some inflation drivers. So those are her reasons for voting to keep rates unchanged last week. ECB Kazakhs, one of their hawks, says US tariffs will not be good for Europe, and that those tariffs could push up inflation. On the ECB's current stance, as the base scenario is lowering rates step by step. ECB's Villeroy speaking more with his Bank of France hat on after those forecasts, says he expects inflation to remain moderate in France. ECB man and Bundesbank head Nagel says Trump tariff plans could cost Germany 1% of GDP. I think they're all still panicking about what could come from that. Days after the election, they're all still throwing up what the risks may be, and Trump must be loving it. Yesterday was a small bit of data out from the US. The NFIB Small Business Optimism Index, which has had a decent rise to 93.7, so more good news for the US economy there. Fed's barking, as was pointed out by Mark in our chat room, was doing a good job of getting splinters on the fence. He said the Fed is in a position to respond however the economy evolves. Inflation may be under control, or it risks getting stuck, and the labour market might be fine, or it may continue to weaken. US consumers, he says, are increasingly price conscious. We'll see how price conscious they will be on Friday when we get the retail sales report. Fed's cash and carry says he continues to be surprised by the economic resilience of the US. It looks like the strong labour market and strong economy will continue. He doesn't want to declare victory on inflation, but there's a good reason for confidence on it. It may take a year or two to get to 2% inflation, given the dynamics in the housing market. If inflation surprises to the upside before December, that might give us pause. That's a heads up for today's data. In a higher productivity environment, the neutral rate is higher, meaning the Fed has less room to cut. But then said currently we're above neutral, and in that they all agree. There was some CPI data out, or expectation data out from New York Fed yesterday. 1 year CPI dropped a pip to 2.9%. 3-year inflation dropped 2 pips to 2.5%, and the 5-year dropped a point to 2.8%. So expectations via the New York Fed for inflation coming a little bit lower. We'll see how that factors into today's numbers. Trump continues to put people into his cabinet and into government positions. One person we know who won't be Treasury Secretary, new Treasury Secretary, is John Paulson. He's dropped out because he says his financial obligations are too big to be able to take the job. Elon Musk is coming into government. This is absolutely hilarious. He and his troop will be heading up the Department of Government Efficiency, which, if any of you haven't worked out, the acronym for that is Doge, which is the meme coin that he likes to throw around now and again. That one that was made up completely for shits and giggles. And so Trump's named that new department after a meme coin, and Musk is going to be heading that up. He says he says he's going to go take all these departments who are wasting money to the cleaners, and he's going to post the results online and create a league table of which departments are wasting the most money. It's going to be absolutely magic. I actually hope he pulls it off because he's aiming to eat into some 6.5, I think, a billion or trillion. I can't remember the number. I lose track of what they're doing over there. But a ton of money that he says he's going to waste. And if he manages to do that, I, for one, will applaud him, as will many others. And it'll become, hopefully, a blueprint for other countries to get people in to do the same. It's going to be fun and games for the next 4 years. On the oil front, OPEC. We had the OPEC General Secretary talking up their book a week or so ago, saying how demand is looking good and it's not as bad as people are making out. Well, yesterday they cut their global oil demand forecast for 2024 to 1.8 million barrels per day from 1.93. They also cut their 2025 demand growth forecast to 1.54 from 1.64. So much for that. It's not as bad as everyone thinks. Over in the UK, bit of a litmus test for the new government. They've done well in the first 3 odd months. They've managed to lose 40% of the council seats that they held since the general election. So these are not MPs; they're just local council seats, which can be made up of several different parties. But they've lost 40% of them since they took over. So there is a bit of a feeling, an anti-government feeling already from voters in those by-elections and council elections. So not looking good, not a good marker for new government policy. That's about it on the headline front thus far. We'll have a look at what's coming up later today. Obviously, US CPI is going to be the big number to watch. We're expecting CPI to go up to 2.6%. Now, there's a bit of a range here. Some are saying 2.6, some are saying 2.5, some people even saying 2.4. But the general gist is that inflation is expected to go up 2 pips to 2.6%. Core, the all-important core number, is expected to remain unchanged at 3.3%. Now, you've got to look out for this one because everyone will be jumping up and down on the services side of things, the rents, all that sort of thing, third decimal places on the monthly number and all that sort of crap. So for those that aren't propeller heads and masters in economics, just concentrate on the headline numbers and see what everyone makes of it later on. Now, this data, you've got to know the Fed stance. At the moment, the Fed is still looking to cut rates. The market, though, is getting a little bit more undovish, and they are all, a lot of the market, a lot of banks are looking for the Fed to slow rate cuts at the least, and some even pausing rate cuts. And as Kashkari gave a nod to there, inflation going up before December could be an indication that they pause. So if we get numbers, even if they hit expectations, if we get CPI at 2.6, core at 3.3, the market is probably going to shave off expectations for cuts in December and moving forward into 2025. So you know which way the market is leaning. Obviously, any data that's much hotter than that, however higher it is going to be a bigger degree of those rate expectations being cut back further for cuts. Obviously, it's a softer number. We see the core coming down, even by a small amount, 3.1%, 3.2%. Headline maybe even coming in unchanged at 2.4%. Then we may get a little bit of a shift away from expectations that they're going to pause on cuts. So that'll be a little bit more dovish, but I don't think the market is going to give up this bone of less Fed cuts quite easily, particularly with Trump on board now and what that may bring. So really the path of least resistance is to see the dollar gaining, yields perhaps gaining. But as I said, it will be on how big a variation the actual numbers are to what's expected, but know which way the market is leaning going in to that. We do get some other Fed heads speaking later on today. Kashkari again, Williams, that might be one to keep an eye on. He's a bit of a Fed bigwig. Logan and whoever else, Schmid later on popping up. Tomorrow is the big day though, because we get Powell speaking as well. So he may want to offer us something depending on how the market's moved today. Right, let's get stuck into some of the prices. And you guys have been a little bit quiet on the old chat the last few days, so don't be shy. If you need me to look at something, just put it up there and I'll have a look. Otherwise, I'll just run through some of the majors and whatnot. Dollar CAD, this is really turning into a bit of a show at the moment. Again, I've got the feeling for this one. I've been saying it for a while. Everyone's been saying it for a while. It looks like in one way, shape, or form we're going to be getting a test of 140. Now, how we get up there is going to be important. Okay, we're mooching around this bloody 139, 50, 60 area. wearing the carpet out, as I posted earlier. What we are seeing though is the dips are becoming far more shallow. So we've got a little bit of a sort of building up pressure here in this type of price action, where we're not busting higher, but you know, the buyers keep coming in, keeping it supported. So this price action tells me that there's a greater chance of seeing a break, more so than seeing it coming all the way back down again. Now, we could be in one of those moments where, yes, the data could be a decider. If we get hot CPI numbers, then obviously dollar's going to rally. That might be the trigger to send this higher for a test of 140. But we could also be in a situation where the market is waiting just to make sure there's nothing too dovish from the numbers. So it's not, if the numbers aren't overly dovish, not a game changer for the Fed in terms of, you know, whether they continue cutting or cut larger. We could be in a situation where if it's not ultimately bad news, this is going to go to 140, whatever. Sometimes you get pairs, and dollar CAD is one of them, that just pauses ahead of big data and big events before carrying it on. It just wants to make sure that there's nothing untoward, and then off we go. So I think there's a strong chance that we have a push on higher unless the data is really, really soft. So could be a moment where if it is soft data but not game changing, we get a fairly decent dip. 139, 10, 20 is the area a lot of people in our chat room are looking at, and I concur with that. So down towards this sort of area, maybe down to 139, a dip down there probably gets bought up pretty quickly, and then that might be the trigger to do a similar move to what we've seen here, where we have a decent dip and then it comes roaring back. So I still think 140, we're going to have a look at it one way or another. Now, if we don't, if we do find that we can't get through here, even after the data, whatever that may bring, then maybe we're going to start to see a few of these longs chucking their positions out the window. That will lead to a steeper pullback. And if we get that, we need to see if it's going to challenge any of these lows in particular. You know, if it comes down to 139, holds there, that's going to be, you know, another series of lower lows, but with a bit of time in between. And again, that would initially be a springboard potentially to then take us up to 140. So who knows? Yeah, exactly, Gavin. It's getting to that point where it's almost seems like a done deal. We're going to have a look at 140. But, you know, does anyone want to buy it here at 139, 50, 60 right on the top? You know, we're not even really getting a dip. It's tough to buy it up here. Break trade is still something I'm looking at. I may even look at tapping it for a short still, just for a little scout, depending on the move. If it's a quick CPI move, I might give it a nudge, but I don't know. It feels like the pressure's building in all this price action, which means if we do break, then it could be a quick run up. And obviously, we can't rule out a quick stop run up through 140s, and then it all reverses, and then we have to do all the work again. So lots can happen. You can try and cover all bases, but it doesn't mean you can necessarily trade all bases. One pair that doesn't give a monkeys for the levels at the moment is dollar yen. We had a couple of goes close yesterday into the 90s, and then overnight we just sailed through it. So this 155 was a big level. It's a little bit undecided now. It looked like it was holding the 155. Now we're back under. Might find that it holds as we roll into the data. But as I've been saying for the last few days, none of these moves that we've seen previously look to be anything that's going to change this trend around that's been happening since mid-September. So on and on it goes. Above 155, then we're looking at levels. Where we go on here? The next level I've got is around sort of 155, 70s. I know other people got a few little levels in amongst here, but for me, that's one of the main levels to watch, or the next main level to watch. And then it's 157, which has seen a lot of traffic previously. But this is going to start pushing the Ministry of Finance's buttons if we're going up here. And irrespective of Bank of Japan hikes, it's not going to stop this at the moment. This is a lot of the dollar and a lot of yields making these moves here as well. So we're potentially back on that bus as far as dollar yen and yields go, and we'll take a quick look at those now. 2-year yields continuing to make fresh highs. Again, this move since mid to late September. Again, we're pushing up at levels that's going to start conflicting with where the Fed's going to be potentially taking rates. So that's still something to bear in mind. Now, Mark pointed this out in our chat room. We're getting up to this 4%, 4.5% mark in US 10s, and that's the price getting down to roughly around the 109 level. So if you're watching bonds, this is going to be a potential make or breaker for what's going on with the dollar. 4.5% is a big level for 10s here, again, based on where the Fed are expecting to take rates to, although it's not a direct move, because obviously 10-year yields is a different duration to the shorter term, but still getting above 4.5% could be a significant move, and that could really kick the dollar on to another leg. And then dollar yen, who knows, could be going back up to the 160 highs, and that's not going to be good for those guys in Japan. So that's just something you need to keep an eye on. Marion just asking, the budget trade for GBP is over from my point of view. Would you like to buy cable or euro sterling after the data? Yeah, it's the budget is, I was saying pre-budget that I didn't think the pound, or didn't think I'd like to be buying the pound into the budget and over the budget, and that's sort of proved to be the case depending on which asset you're looking at. What we've seen the last couple of days, though, is a lot of dollar move, and it's been usually cable and euro dollar go at roughly the same time, so they move roughly in the same direction, which they have been. But yesterday we were just getting moments where euro dollar wasn't moving, but cable was falling, and then cable wasn't moving and euro dollar was falling, and that's jumping around euro sterling at the moment. If you want to buy cable, you need to be careful, because we keep hitting levels looking like we're holding, and then it crumbles. So we've hit another level here, which is a 61.8 fib down around this 30s area, which is a bit of a level going back on its own as well. But at the moment, the bounces are looking very weak. Okay, we're not really bouncing at all, particularly for something like cable, not even getting 20 pips off some of these moves. So it's not looking bullish at all. Nothing here is getting me the feeling that I need to jump into cable longs. I did try that, in fact, at 128, and I got a bit away for 10 pips and then got stopped on the rest for whatever it was, 7, 8, 9 pips on the balance. So I tried a little knife catch. It didn't work. I'm not yet ready to try a knife catch around here, particularly on this data. If you're trading ahead of the data, then really you're taking a punt on the data being softer, and that's not my kettle of fish, Marion. So budget aside, we have got a bit of an area down here, a bit of a zone, okay, one of the traffic zones that has seen a lot of action. So maybe that sort of area is where I'd potentially look to try and catch the knife. It's an area that's seen a lot of action, and those are the sort of areas that we didn't see as much action here. It's maybe not as big a level. This maybe be a bit of a bigger zone. So down to 126, 60s, 70s, that's the area I would look at potentially for long if I wanted to fight this move. And if it trades that over the data and gets there and holds, then maybe you can have a little scalp. But I don't think this is for turning just yet. Maybe at some point it will, but if this dollar move continues, and again, keep your eye on yields. If those 10-year yields are going through 4.5%, then even I would be a bit hesitant to even try along against that level. We could be, this is something I was speaking to Blake, we could be, this is either still short-term noise post-election, money coming back from the sidelines, or it could be the start of a monster dollar trend if Trump's policies lead us this way. The problem is we don't know. But you can define it by the levels. So if we carve through this 126, 65, 70 level, then that's going to look very bearish. And again, knife catching is not what you want to be trying here. Yeah, and you're right, David. You unless you get a decent rally, rally to 128, and that holds, then maybe it gives you something to get into, to sell into, maybe even back up to here, 128, 40, 50 area. And you get a rally up there and it holds, then maybe that's the one to hit for shorts to try and keep with the trend. But yeah, definitely can't sell it down here either. So that's a difficult thing. You'd love to sell it up here, but are we going to get there? You always want to sell it up there when the price is down here. But did anyone sell a break when we broke through there? No, that's why you got to look at these things. So, you can, if you get a break at this level and then it retests and it holds and confirms as a break, then that's your trigger for getting in shorts. But right now, it's not even giving you confirmations of half of these moves. Euro sterling, we'll look at that, Mariam, while we're on it. So this broke under 83s, was holding under 83s. We had a few tests yesterday, and then on the second attempt or third attempt, late yesterday afternoon, it broke back up. And again, this was on pretty much cable getting whacked, and the pound getting whacked in general, while euro dollar was holding around the 106 area. Where's it running into trouble? 83.30s, which has been one of those levels where something always seems to happen, whether we're going up to it, coming down to it, or whatever. So this is the marker. If we can't get above there, it's just keeping, again, this downtrend in play because we're not pushing up. I don't know where it goes from here. There's a lot of dollar in this, okay, rather than what's going on between Europe and the UK. So it is about what's happening in euro, sterling, and cable. So if you're trading this one, but if the levels are holding, then obviously you can go ahead and have a trade. But if we get another test of 83 and it holds, and you want to try long, Mariam, then that's probably the low risk area to try it. And but you've got to be very quick, I think, in taking profits in this one, at least taking partials, and then protecting the rest. Euro dollar. Again, similar viewpoint to cable. We've been turning around this 106.11, 10.11 area. Let's go into that. Let's go a bit wider. Which was, if you can see it, just in there, an old 38.2 fib. And what was it? Looking at a sync. What's going on there? Let's come in a bit. So it's a 38.2 fib, this area. We've been down here before, and I'll zoom it in a bit. So we're a bit undecided what we want to do. We can't get below 106 and hold. Below there, we've had a couple of spikes under, but we can't stay under there. But we can't stay above this or below this 106, 10.11 area either. So again, indecision going on here. This 106.35 is 30.35 is your near-term area. If we can't get above there, then it's going to keep the momentum going again, the bearish momentum. So this is your marker. But if we're still messing around here over the CPI, then you're going to probably get a reaction one side or the other. Again, let it settle down. Don't think just because the CPI data has sent it above 106.30, 35, that that's it. We've bottomed and we're going to be going back to 108. I think this is in heavy sell the rally mode. Okay, so any decent rally you get in here is likely to see the sellers coming in. Certainly back up 106.70 up towards the figure. 106.90, I think, is probably the place where sellers are going to come out in earnest if they want to keep this downtrend moving. And on the other side, if we get below 106 and start holding it, then the downside beckons, and then we'll be looking potentially at my oh, come on, we'll be looking at my 105 zone down here, the big 105 level. We got a little bit of the zone up to 105 2030s. Okay, so under 106, it's all about this 105, and this 105 could be massive, absolutely massive. Main, what? Oh, talking about the dollar. Once dollar starts to reverse, which one will be your top pick? I don't know. I don't know which one's going to move more. Aussie, cable, Kiwi, maybe. Aussie, I don't know, because that's going to be heavily tied to what's going on in China. And then I don't know how much the dollar's going to reverse, or by how much. Is it going to be 5, 50, 100, 5? Who knows how many pips it's going to be? It's folly to guess how much it's a dollar bounce is going to take back. What I would say, though, the more we continue this straight down move, then the potential for decent reversals is likely. That's when you're probably into your 100, 150 pip reversals, because shorts are getting shorter and shorter and shorter and shorter. The positions are building up, so the reactions, if we get a bounce, will be far larger because there's more money who will be getting out of positions. So the longer and further we go and faster we go, the bigger the positions are, the more likely you get a bigger reaction just by pure size. All you do is that's when I use fibs a lot. Okay, so once we do show signs of bottoming, I'll probably chuck a fib in here. It'd be quite short term, but a couple of months is a good amount, and then you can judge what your bounces are going to be like. If you bounce to a 38.2, that might be a fairly decent bounce. But if that's where the sellers come in again, then that gives you your levels. So catching knives is always dangerous. You want evidence that a price has stopped falling, something like this sort of price action. That's pretty clear. 3 attempts to go through and it doesn't, then you get a bounce and off it goes. So that's what you want to look for. These patterns are what you want to look for anytime we want to try and pick a bottom. This isn't a bottom. Okay, we may have stopped twice over the last couple of days, or twice in 2 days, but that's not a bottom for me until we get more evidence, more price moves that confirm there's a bottom there. And if you get something like that, then you can start trying to catch the knife and seeing where it goes. And it could go 50 pips, could go 100 pips, could go 200 pips. Who knows? You can only trade it when it moves, mate. So, take profit, lock in your stops, and just try and sit on the trade as long as you can. And if you sit on it long enough, then maybe you get a move like that. Or maybe you just get a move that's a couple hundred pips before it comes back down again. So as long as you're taking profit on the way, you don't know where it's going. Brian, I sold my crystal ball years ago. Gold, yeah, it's another one. Again, a lot of these pairs and assets are doing similar things. They've come off highs, they've hit downtrends, and now they're just starting to hold various levels. Gold is another one. So we came down to the 61.8 fib, had a little nudge underneath it. I had a level here that I drew on the way up, just in there, so it's hit that. So it's a bit of probably call it a bit of a zone, 26, 25, 90s, 89, 90s up to 26. So a bit of an area in here that it's holding, but again, the bounces are very weak. We can't even get back to give this 26, 22 level a retest. So that will be one that is interesting me. If we get a move up to there and maybe 26 is even 22, 26, get up there and hold it, then again that's going to keep this downtrend in play, and then maybe the sellers come in and then we see a move much lower. So for me, we're not out the woods on this. Of course, if you want to try longs, you know where you're wrong. Under 25.89, you're starting to be wrong. So you don't need to give it a lot of room under there if we're breaking down. So you can try all these little levels, try catching these knives, but go smaller trades, tighter stops, so you don't lose too much money if they do break. Because if you tried catching a knife, you know, all along this, unless you caught a decent one there, you know, you would have lost money catching a knife there, catching a knife here, catching a knife here, that sort of thing. So you don't want to end up losing 5 trades on the trot just to try and catch one that you won't even get your money back on the prior 5. So pick your points, let the price action tell you where to get in and what to do. But for me, yeah, this is still looking bearish for gold, bearish commodities in general. Have a look at old copper. That's looking in all sorts of trouble still at the moment. So much for Chinese stimulus. If you are looking at metals, copper down to this 404, 405 area, it's going to look a bit interesting. But then I thought it was looking interesting for longs around this 430s, but it couldn't hold there. So this is quite a decent level down here, as you can see, going back. So if China hopium trade comes in, if manufacturing starts picking up, then you would potentially expect copper to base. That's outside of all, obviously, the demand production and everything else going on in that one. While we're on commods, oil, again, still looking pretty weak down here. WTI still on this pretty big level down here. Could we get a break? It's possible. But it's also possible that we hold again down here. There's a reason why we've spent the last 2 years not being able to get through down here. There's a lot of firms who have production points down here, break-even points down here around that level. That could be one reason why we don't go below it. So I don't, again, demand side, fundamentally, I don't see any reason for oil to be going up. That's been the case for, well, last year or so, if not longer. But levels are going to come into play somewhere. Assets got to bounce somewhere. So again, it's a potentially low risk area to try. Below 65, 66, you know, the trade's looking wrong. You can have maybe draw a stop down, tighter trade, stop down below this sort of double bottom down here, down at the 61, 62 area. Stop below there. But yeah, I'm not so keen at the moment to try longs down here, start catching the knives. Right. Anyone else for anyone else? What else do we need to look at? I'll have a quick look at my Aussie Kiwi. Where are we going? Here we are. As you know, I've been playing this one on the short side. It's doing a little bit of mooching around this 110, 15, 20 level. I want to see it below and holding below, because while it's just doing this up and down, up and down, up and down, it keeps the upside in play. Again, the lows coming in higher than prior lows. So just for the short term, it's still looking fairly bullish. It's a bit sideways when you come out a bit, but we're not looking like we're breaking this just yet. So I want to, first step, I want to see it back and holding below this 10, 110, 18, 20, whatever you want to call it, and then taking on these prior lows down here. If we do that, break below there, then we could be heading lower. But it looks like this one's going to be a bit of a waiting game, but I'm set up for that anyway. So I will continue to sell any decent rallies in it as well. Dollar China, I mentioned before. It's looking like it's a bit against what's going on in other dollar pairs. Dollar is still pretty bid around the grounds, but this one's come off a couple hundred pips since that news overnight in China. So I don't know what's going on. I don't know if this is a dip that's worth looking at, but I'm still more looking to play the short side. It could have legs to dip by down here for at least a return back to the highs. But I like trying to play the extremes in this pair. This is why I like trading China. I like trying to get the extreme levels, because they're the levels where the PBOC and officials come in and jawbone it. And if they jawbone it strong enough, it can turn the pair right around. So that's why I'm looking to try and maybe start shorts up into this area, 728s up to those highs, because I believe that that's going to be too strong a level for the Chinese like it was previously. And if it's not, I'm not going to go too big on my trade size, because again, if it is a monster dollar rally that we're just about to face, then I don't want to be pissing into that wind too strongly. S&P, yeah, let's have a look at that. Where is it? Non-stop. You can see the last time I had a look at this one. I need to have a little bit of a chart clean up, I think. Yeah, it's not been a while. Well, it's been a while since I've had a look at this one. Let's just chuck something in now, just to get my levels updated. Moonshoot, really. Where's the top? Who knows? We've got a marker there now, 60, 28, 29, 30, whatever you want to call it. That's your level to look at the moment. If you want to come in a bit, we might be developing a bit of a level across there, just on the short term. So keep an eye on that. That's why I've got all these little hundreds of levels down here, and I haven't cleaned it up. Just when you have a market that's going into uncharted territory in terms of price action, like there's no prior history, you've got to let the levels build up. So there might be a little level coming in across here as well. So once you start to build up the picture, then you know roughly how to trade it, because you can see which levels become stronger, which levels become weaker, and then which levels to rely on. So we're definitely not done with, potentially not done with the upside. This is a break point, because we got up here, we tried it several times, then we broke it right after we've held it. This is what you want to see from a technical point of view. Confirmation of a break, that gives you conviction. You can get in longs and see where it goes. You need to do the same thing on the top. Where is the resistance going to come in that is strong enough to stop the price from going higher? So here we have two levels that may be in, well, three levels if you take the high, but two that have seen now some action every time we've been here. Resistance, support, resistance. Okay, and you just let it build up over time. Might take a couple of days, might take a couple of sessions, but that will give you a mark as to what the price has got to do to keep going, or what the price has got to do to start reversing. And then you just start grading your levels, which ones are stronger. Okay, so for me, there's no reason why stocks should go down anytime soon. Obviously, you're going to get pullbacks and moves and whatnot. So yeah, just trust your levels, know where you want to buy it and know where you want to sell it, and don't worry about your bias. Just remember that stocks haven't gone down for 15 years now. Head and Shoulders, no idea. I don't use it, Paul. I very rarely go to the hairdressers these days, unfortunately. So could be, you could get a little wonky Head and Shoulders in here, but that's not a pattern I look for. And the thing with Head and Shoulders, and I always tell this to people, if you're looking for Head and Shoulders to develop, you don't need to wait for it to develop before you trade it. Okay, you've got, if this Head and Shoulders is going to play out, then it's potentially not going to go above here. In an ideal world, one shoulder, head, one shoulder. So if you're thinking that you have to wait for this to break, why not just have a short here? Why wait all that time to see that break and then go for your measured move? This price action is telling you what it's doing before Head and Shoulders even happened. Okay, so if you want to, and these patterns, again, all about patterns, these patterns can get you in a trade before your formations, your Head and Shoulders, your whatever, your hunchbacks, whatever monkey patterns you like looking at. They can get you in far earlier than waiting for the trade to play out. So, a lot of clear Head and Shoulders, people could have been trading it much earlier. and don't have to worry about the pattern. Just trade the damn levels. Right, I think we'll call it a day for today. Thank you very much, everybody, for coming to the Flow Show as always. Do trade safe over the CPI data later. If you're in the chat room, then we'll be covering that live on F.A.C.E. If you're not in the chat room, we'll be covering that live on F.A.C.E. So catch us there later on, and we'll give you an update on the data as it happens. Have a great day, everybody. Trade safe. See you tomorrow.